Investing your money might seem like a tricky puzzle, but it doesn't have to be that way. With the right strategies, you can grow your wealth and hit those financial goals you've been dreaming about. In this video, I'll walk through 4 simple yet powerful investment strategies to help you build your wealth in 2024. 4. Diversify your portfolio. This might sound fancy, but it's really just about spreading your money across different types of investments to reduce risk. Imagine you have all your eggs in one basket. If that basket drops, you lose all your eggs. But if you have eggs in a few different baskets, losing one basket isn't such a big deal. That's diversification in a nutshell. To diversify, you can put your money in a mix of stocks, bonds, real estate, and even things like gold or oil. For example, you could buy shares of companies from different industries like tech, healthcare, and finance. This way, if one industry has a rough patch, the others might still be doing okay, balancing things out. Adding bonds to your mix is another good move. Bonds are like loans you give to companies or governments, and they pay you back with interest. They're generally safer than stocks, but they usually offer lower returns. Real estate is also a great option. You can buy physical properties or invest in real estate investment trusts, REITs, which let you get into real estate without actually buying property. And don't forget about commodities like gold or silver, which can be solid investments, especially when the economy is shaky. Diversifying your portfolio helps you manage risk. If one type of investment isn't doing well, another might be thriving. For example, if the stock market is down, your investments in bonds or real estate might still be going strong. This balance can protect your overall portfolio from big losses and keep your investment journey smoother. Let's say you have a mix of stocks from different sectors: technology, healthcare, and consumer goods. If the tech sector takes a hit due to some regulation changes, your healthcare and consumer goods stocks might still perform well. This mix reduces the risk of your entire investment taking a nosedive. The same idea applies to adding bonds and real estate to the mix. Bonds can be a safer bet during market volatility because they tend to be more stable. Real estate can offer steady returns and isn't as closely tied to stock market fluctuations. Also, commodities like gold can act as a hedge against inflation and market downturns. 3. Invest in index funds. This is a fantastic way to build wealth without having to stress over picking individual stocks. An index fund is a type of mutual fund that aims to track the performance of a specific index, like the S&P 500. When you invest in an index fund, you're basically buying a tiny piece of all the companies in that index. One of the best things about index funds is how easy they are to use. Instead of spending time and effort choosing which stocks to buy, you can invest in an index fund and get a ready-made diversified portfolio. Plus, over time, index funds tend to do well because they mirror the overall market's growth. Another perk of index funds is that they usually have lower fees compared to actively managed funds. This is because index funds don't need a team of managers deciding what to buy and sell. Lower fees mean more of your money stays invested and working hard for you. Investing in index funds is like taking a shortcut to a diversified portfolio. Instead of researching individual companies and constantly keeping up with their performance, you invest in an index fund and let it do the work for you. For example, the S&P 500 index fund includes 500 of the largest companies in the United States. When you invest in this fund, you own a small piece of each of these companies. If one company doesn't perform well, it's balanced out by others that do. Over time, this diversification tends to yield positive returns because the overall market has historically grown. 2. Focus on long-term investments. When it comes to building wealth, having a long-term perspective is key. The stock market can be a roller coaster in the short term, with prices bouncing up and down. But over the long run, the market generally trends upwards. Think of investing like planting a tree. At first, the tree is small and delicate. It might not seem like it's growing much, but with time, it gets stronger and starts to grow taller and thicker. The longer you let it grow, the bigger and more impressive it becomes. The same goes for your investments. The longer you keep them, the more they can grow and compound. By focusing on long-term investments, you can avoid the temptation to react to short-term market swings. This means not panicking and selling when the market takes a dip, but instead holding on and letting your investments recover and grow over time. Investing with a long-term mindset helps you stay calm during market ups and downs. It's easy to feel anxious when you see your investment value drop in the short term, but if you remember that you're in it for the long haul, it's easier to ride out the volatility. Historically, the stock market has shown an upward trend over extended periods, so while there might be downturns, the general direction has been positive. For example, during economic downturns or crises, the market can take significant hits, but over decades, these dips often look like small blips on the radar of an overall upward trajectory. By staying invested and not giving in to the urge to sell during these dips, you allow your investments to recover and benefit from the market's long-term growth. 1. Dollar cost averaging. This strategy involves putting a fixed amount of money into your investments amounts at regular intervals, no matter what the market is doing. For example, you might decide to invest $200 every month. Sometimes you'll buy when prices are high and other times when they're low. Over time, this approach can help smooth out the ups and downs of the market and reduce the risk of investing a big chunk of money at the wrong time. Regular contributions also take advantage of compound interest. As you keep adding to your investments, the returns you earn start generating their own returns, creating a snowball effect that can boost your wealth over time. Think of dollar cost averaging like buying groceries. Some weeks, certain items might be on sale, while other weeks, the prices might be higher. If you consistently buy groceries every week, you average out the costs over time instead of spending a lot during expensive weeks and less during cheaper ones. The same idea applies to investing. By investing regularly, you average out the purchase price of your investments over time, which can lead to better long-term results. Also, setting up automatic contributions to your investment accounts can make this process even easier. Many brokerage accounts allow you to set up automatic transfers from your bank account. This way, you don't even have to think about it. The money gets invested regularly and you can stay on track with your financial goals without needing to remember to make each contribution. Investing can seem overwhelming at first, but it really boils down to a few key principles. By spreading your investments, keeping things simple with index funds, thinking long-term, and consistently adding to your portfolio, you can build a solid foundation for your financial future. Remember, the goal is to make your money work for you, and with these strategies, you're setting yourself up for success. I hope that you found this video helpful. If you did, don't forget to like, comment, and subscribe for more.